Hello, and welcome to Investment Insight, your clear take on the markets. Let's get started. Today, we are embarking on a deep dive, analyzing some really critical research materials that point to two major stories driving the global economy, and these are stories that are often overlooked.
They really are. We're not talking about the usual day-to-day market swings.
No, not at all. These are, deep structural geopolitical forces that are fundamentally reshaping how the world moves things around and, frankly, what the world buys.
That's absolutely right. And what the data shows is a deep structural paradox right now.
Yeah.
On one hand, you have the cost of moving everything. I mean, every single commodity, every finished good. It's being driven up by global conflict and inefficiency.
A logistical squeeze.
Exactly. But on the other hand, you have this massive industrial force, China, which is exporting manufactured goods at a rate we've never seen before.
And at prices that competitors just can't match. So that's industrial overcapacity.
Inefficiency versus overcapacity. That's the core tension.
And our mission today is to unpack these two competing forces. We're going to show how they're connected and explain exactly what this shifting global trade picture means for your portfolio as we head into 2026.
So we'll start with that first piece, the structural inflation that's being built right into the global supply chain. The big question is, why are shipping costs soaring at the end of 2025?
Yeah, why? Because every historical metric, every chart you look at says they should be dropping right now.
They should be. It's not a boom. It's something else.
And then we're going to pivot to this really surprising story behind China's new export dominance. While all the media attention is on EVs, Tesla, BYD, the data shows China is quietly becoming the world's biggest car exporter by flooding emerging markets with millions of gasoline cars.
The old internal combustion engine.
Exactly. And this huge volume of cheap IC cars is rewriting the rules for global energy demand and posing a massive challenge to legacy automakers. So let's jump right in.
Well,
Let's start with the chaos on the high seas.
Okay, so if you're someone who follows traditional supply chain data, you have a certain rhythm you expect to see during the year.
Right. There's a seasonality to it.
There is. And late in the year, particularly after the big holiday rush, all the Black Friday and Christmas orders are done, you expect shipping rates to cool down.
The demand just softens. Logistics companies are getting ready for that quiet period in January, February.
That is the historical rhythm of global trade. It's been that way for decades.
But the analysis we have for 2025 shows something completely different. It points to an unprecedented year-end surge. It just completely defied that seasonal drop.
It did. And that tells us right away that we are not dealing with a normal economic cycle. But this isn't a sign of a healthy, robust surge in economic demand.
No, this is a structural issue. It's driven by politics, by conflict.
So what specific indicators are flashing red here? What's signaling this anomaly?
Well, you have to look across the entire spectrum of maritime transport because this shock is, it's ubiquitous. It's happening everywhere. Let's start with dry bulk. Okay, so for our listeners, dry bulk. These are the ships carrying the fundamental raw materials, right? Iron ore, coal, grains.
Building blocks of industry, exactly.
Right.
And the most widely watched indicator here is the Baltic Dry Index, the BDI.
And what did it do?
By late November, the BDI was nearing a 2-year high, a huge spike right at the end of the year.
And which specific vessels are driving that BDI increase? Is it across the board or is it concentrated?
It's heavily driven by the biggest ships in the fleet, the massive Cape-size vessels.
These are the ones that are too large to even fit through the Suez or Panama canals, right? They have to go the long way around continents.
That's them. And the reason they're in such high demand is this surge in the need for iron ore, particularly from China. Their steel industry's demand meant that these largest carriers were fully utilized, completely eating up any slack in the market.
So any expected seasonal softness just evaporated.
Completely. Now let's look at energy transport. This is often the most volatile sector, and it's where the geopolitical risk really shows up.
Sure, oil and gas.
Exactly. And the ships carrying them, the tankers, they experienced an even sharper shock. The rates for moving crude oil and refined products like gasoline or diesel, they soared to a 5-year high after October.
A 5-year high. And they've stayed there.
They've remained stubbornly elevated. This reflects this deep insecurity around energy sourcing that's directly linked to sanctions, which we'll get into in just a minute.
And of course, there's natural gas. We're also seeing the cost of moving that reflected in this rate anomaly, which is a massive expense for consumers, especially in Europe.
This is probably the most staggering indicator of the real-world geopolitical costs we're talking about. I'm referring to LNG carriers' liquefied natural gas.
Okay.
So because of the strategic decision by the US and the EU to substitute Russian pipeline gas with seaborne LNG, combined with, the start of winter demand,
And demand just spikes.
it spikes. And the spot rates for that crucial US to Europe route hit 2-year peaks. The data is just incredible. We're talking rates between $98,000 and $130,000 per day.
$130,000 a day. That's extraordinary. Just to give our listeners some perspective on that number, think about that daily cost. For a high-end luxury home in many U.S. cities, you are basically buying a new house every single day just to rent the ship that's moving the gas.
It's a fantastic analogy.
Yeah.
And that is the true cost of this energy transition and geopolitical security playing out in real time.
It's pure cost-push inflation right there.
It really is. And then finally, you have the containers. These are the box ships moving all the finished goods, your electronics, your clothes, from Asia to Europe. And here, rates remain volatile, but structurally high all year long.
And the reason for that is pretty stark, right?
It is. The research shows that global forwarders and the major carriers, Hapag-Lloyd, Maersk, the big names, they've basically all agreed that a normalization of the Red Sea route in 2025 is simply off the table.
So they're not even planning for it anymore. They're operating under the permanent assumption of disruption.
That is their new baseline. And if the expectation is continued disruption, then these higher structural costs are just locked into the system.
Okay, so that sets the stage. Let's dig into the why. The research identifies 3 main forces driving these costs: geopolitical sanctions, war and route avoidance, and the resulting inefficiency. Let's start with factor A, geopolitical sanctions, specifically the ones targeting Russian energy. The source materials we've looked at point to a real game-changer moment back in October of 2025. This was with the expanded U.S. OFAC sanctions. What exactly changed then, and why did it cause this immediate spike in global rates?
Well, these sanctions were incredibly strategic. They were much more targeted than previous rounds. They went directly after the major Russian producers themselves. We're talking Rosneft, Lukoil, the giants.
So it wasn't just a broad sanction on the country's energy sector.
No, it was surgical. And the goal wasn't just to restrict Russia's access to Western finance. The real aim was to cut off their access to the entire global ecosystem of trade.
What does that mean in practice?
It means the immediate consequence was that nearly half of all existing Russian crude export transactions became, for lack of a better word, commercially toxic. Any non-sanctioned bank, insurer, or logistics firm that touched that oil was running a huge risk of secondary sanctions.
So the risk premium just went through the roof.
Exactly. And it wasn't just the producers they targeted. It was the ships they rely on to move the oil. The infamous gray fleet.
Ah, yes. We hear this term a lot, the gray fleet or the dark fleet.
Right. And the US and the EU are aggressively targeting the logistics infrastructure of this trade. This fleet, it's an armada of roughly 440 older vessels. They're used specifically to transport Russian oil, and they often operate without the traditional Western insurance for oversight.
So they're hard to track. They're outside the normal system.
Very much so. And the sanctions specifically added over 100 more of these ships to the block lists. It's a direct attack on the physical transport layer.
Okay, so this sounds like a high-stakes game of whack-a-mole. Russia finds new ships to use. The West targets them. But the key question for our listeners is, how does targeting Russian vessels and their oil instantly make non-Russian oil shipping more expensive for everyone else?
That is the crucial mechanism, and it creates what the industry calls clean fleet demand. It works like this. If you're a major refiner in, say, India or China, and suddenly half of the Russian crude you used to buy is now flagged as high risk,
They can't touch it.
you can't risk it. So you have to pivot immediately. You have to scramble for what's called sanction-safe supply. And that supply is coming from regions that are much, much farther away. The U.S. Gulf Coast, Brazil, the Middle East.
And this sudden pivot creates a surge, an unexpected demand spike for the limited supply of non-sanctioned, well-insured vessels, the so-called clean fleet.
You got it. And that leads us directly to the mechanical driver of the rate surge itself. It's a concept called the ton-mile effect.
Okay, let's drill down on this because it's a bit abstract, but it's the metric that really determines the profitability of a vessel and the cost for the consumer.
Right. Shipping rates aren't just calculated by the volume of stuff you're moving, that ton. They're calculated by the volume times the distance it has to travel, the mile.
Volume times distance.
Exactly. So let's visualize it. Before this big escalation in sanctions, a significant amount of Russian crude was shipped on relatively short voyages. Think from the Baltic Sea or the Black Sea to nearby destinations in the Mediterranean. Short, efficient trips.
Makes sense.
Now, that same refiner in Asia who needs that oil is sourcing it from the U.S. Gulf Coast. That journey is roughly 12,000 nautical miles as they can go through the Suez Canal. Or if they have to detour around Africa, it's more like 16,000 miles.
So the demand for the oil itself hasn't changed, but the distance required to fulfill that demand has just exploded.
It's exploded. It's like a geopolitical toll booth has been set up that demands more sailing time, more fuel, more crew costs, and therefore much higher prices.
And analysis from firms like Vesanautical, they're confirming this, right? They're seeing this structural leap in the average distance traveled.
They are. Their data shows the ton-mile metric has jumped, and that is what's locking in these high rates. It's not a short-term blip. It's a structural change that will persist for years unless the entire geopolitical landscape fundamentally shifts.
And this complex web of sanctions leads us right to the next factor, the purely physical disruption. Factor B, war and route avoidance in the Red Sea. We hear about the Houthi attacks constantly, but the source material really quantifies the scale of this crisis. It says over 190 incidents have been recorded through 2025.
That number is just staggering. And what it means in physical reality is that the Bab al-Mandab Strait, which is the gateway to the Suez Canal, is essentially a high-risk war zone for commercial shipping.
It's a no-go zone.
It's a no-go zone. The data shows that vessel traffic through that critical choke point has decreased by over 60% compared to 2023 levels.
60%. That is a colossal number. This isn't just about a few ships taking a different route. This is a massive, vital artery of global trade that has been effectively clamped shut.
Clamped shut is the right way to think about it. And this is precisely why the major carriers are now operating under the assumption that normalization is off the table.
Even if a ceasefire were announced tomorrow.
Even then, they know the insurance premiums, the risk premium, will remain too high for the foreseeable future. So their operational plan now is to route all Asia-Europe container and product tanker traffic all the way down and around the Cape of Good Hope in Africa.
Which adds thousands of miles and weeks to the journey.
Exactly. And this brings us to an idea we touched on earlier, which is really important for understanding the impact. We call this the invisible capacity reduction.
Okay, let's break that down. The idea is that you don't have fewer ships in the world, but the world has less available shipping capacity. How does that detour actually translate into a real loss of capacity?
It's simple math, really. A standard round trip from Asia to Europe via the Suez Canal might take, say, 80 days.
Okay.
By routing that same ship on that same trip via the Cape of Good Hope, you're adding at least 10 to 14 days, and sometimes as much as 3 weeks, to the total voyage time.
So a ship that previously made, let's say, 4.5 round trips in a year.
Now it might only manage 3.5 or maybe 4 if they're lucky.
So if every ship on that route is making 20% fewer trips, the global effective capacity for that trade route has just shrunk by 20%.
Precisely. Even though not a single ship has been scrapped. This structural delay acts exactly like taking a huge chunk of the fleet out of commission. It's an enforced operational inefficiency, and it is the primary structural driver of the volatility and the high rates we're seeing in the container and product tanker markets.
And it's not just the Red Sea, right? The war contributes in other ways. We're still seeing disruptions in the Black Sea, and the drone attacks on Russian refining capacity are forcing more of their products onto these riskier sea routes.
All of these factors compound the problem.
Okay, so let's combine those first two factors with the third one, factor C, which is that supply increases are meeting this inefficiency. Now, on the surface, you'd think if the supply of commodities is increasing, that might help rates stabilize. But that is not what the data is showing us at all.
No, and that's the great irony here. The world is physically moving more volume than ever. Global seaborne crude shipments, for example, rose by 0.6% in the first 9 months of 2025. That's largely driven by increased output from the U.S., from Brazil, from Guyana.
And LNG is the really dramatic one.
It is. U.S. LNG exports hit a new record in November, and the data shows 70% of that volume is now heading to Europe. The EU's reliance on seaborne gas meant they imported a record 284 billion cubic meters of it in 2025.
And in dry bulk.
Same story. China's iron ore imports were up 7%, which put sustained pressure on the demand for those big Capesize vessels we talked about.
So to put it simply, we have record high volumes of stuff that needs to move around the world, but the fleet available to move it, the supply of ships, is basically stagnant.
Stagnant, and, as we've established, hobbled by all these geopolitical constraints. It creates the perfect industrial bottleneck.
So what does the fleet growth look like?
It's almost non-existent. Analysis from industry bodies like BIMCO projects extremely low tanker fleet growth, only about 0.5% in 2025. Some classes of ships, notably the mid-size Aframax tankers, are actually seeing more vessels being scrapped than are being delivered from shipyards.
So the fleet could actually be shrinking in some key segments.
It could be. So the ships available are few, and their effective utilization rate is terrible because of the sanctions, because of the detours, and this is a crucial last point, because of environmental regulations.
Right, let's spend a moment on that because these regulations compound the inefficiency problem. We're talking about slow steaming.
Yes, new environmental regulations from the International Maritime Organization are requiring ships to reduce their speed to cut carbon emissions.
Which is a laudable goal environmentally.
Of course. Yeah. But in operational terms, it means the ships spend more time sailing and less time in port, which further contributes to that invisible capacity reduction we discussed. If a regulator mandates a 10% speed reduction for a certain trade lane, that is functionally equivalent to scrapping 10% of the fleet on that lane.
So, to pull this whole section together, to synthesize this complex logistical puzzle for our listeners, we have three interlocking forces. We have sanctions forcing ships to sail much longer distances.
Right.
We have war forcing ships to take these huge detours around Africa. And we have environmental rules forcing ships to sail slower everywhere. And all of this is hitting a global fleet that is not growing.
It is a fundamental, expensive structural lock on persistent supply shock inflation. There's no other way to describe it.
So given all that, what does the outlook for 2026 look like?
Well, the consensus view among industry analysts is, let's say, brutally consistent. They are all forecasting high rates and high volatility to continue.
So no relief in sight.
There's no major relief valve available unless the entire geopolitical picture fundamentally shifts, which, nobody is banking on.
What would it actually take for shipping rates to return to, say, pre-2023 levels? What would have to happen?
It would require a massive synchronized series of events. First, all the major carriers would need to feel safe enough to fully return to the Suez and Red Sea route all at once.
Okay, that's a huge step.
And at the same time, the U.S. and the EU would need to dramatically relax the sanctions on Russian energy trade. That would suddenly free up that whole gray fleet and, crucially, reduce that ton-mile requirement for the clean fleet.
And are any industry CEOs actually factoring that scenario into their plans for 2026?
Not at all. They are planning for structural disruption as the new normal. That is their baseline scenario.
Okay, let's pivot from the industry to the macro view. This persistent cost increase, it's a classic supply shock, right? It's very different from demand-driven inflation. What does this mean for inflation forecasts and, critically, for central banks like the Fed?
It means this freight spike is highly inflationary. For countries that rely heavily on seaborne trade, think Europe, Japan, it immediately pressures their import costs and their producer price index, or PPI.
And for the U.S., even though we have a more domestic-focused economy.
Even for the U.S., with all our domestic strengths, this raises the inflation floor on all the imported goods we buy. Durable goods, electronics, clothing, you name it.
So if the inflation is coming from these external supply shocks, a higher shipping cost, how does that complicate the job of the Federal Reserve?
It complicates it immensely because the Fed's primary tool for fighting inflation is raising interest rates.
Which cools down domestic demand.
Exactly. It's designed to slow down our own economy. But when the inflation is being driven by external factors, a war in the Red Sea, a sanction, a detour around Africa, rate hikes are much less effective.
They can't make a container ship travel faster?
They can't. They can crush domestic spending, but they can't solve the geopolitical problem. And so this persistent cost-push inflation forces the Fed and the ECB in Europe to remain much more cautious. It justifies a much slower pace of any potential interest rate cuts.
So the dream of returning to 0% interest rates.
The data indicates that remains highly unlikely for 2026. The structural inflation is just too sticky.
Okay, so let's translate that into portfolio strategy. If we're entering a sustained period of high rates, high volatility, where inflation risk is structural and not temporary, what's the investor consensus on how to position a portfolio?
The consensus really favors reducing your dependency on what we call long-duration assets.
Okay. For the economic beginner listening, can you break down what a long-duration asset is?
Sure. Think of it as any asset whose value relies heavily on earnings that are expected far out in the future. The classic examples are long-term government bonds or high-valuation growth stocks, like many tech companies.
And high interest rates are bad for those.
Very bad. Because high interest rates are used to discount those future cash flows more steeply. which hurts their value in the present. The promise of $1 10 years from now is worth a lot less when you can get a guaranteed high return on your money today.
So the strategy is to shift away from those future promises and toward things that perform better right now when money is expensive and costs are rising.
Exactly. The key is maintaining your allocation to inflation hedges. That means things like commodities, energy, hard infrastructure, and certain value stocks, specifically those that have strong pricing power.
Let's get really specific now. Who are the direct beneficiaries? Who are the clear winners of this entire logistical mess?
Well, the most direct winners are the companies that own and operate the vessels themselves, specifically in the highest demand classes.
So the ship owners.
The ship owners, we're talking tankers,
Yeah.
especially the larger classes,
Yeah.
the Aframax, the Suezmax, and the massive VLCCs, very large crude carriers, also the LNG carriers we mentioned, and the dry bulk vessels like the Capesize.
And why are they winning?
They're benefiting from spot rates that are sometimes double their daily operating expenses. And at the same time, the value of their physical assets, the ships themselves, is rising rapidly.
But I have to challenge you a bit here. Aren't shipping stocks notoriously risky? Analysts are always reminding us that this industry is wildly cyclical. If the geopolitics were to normalize tomorrow, couldn't these stocks just crater?
That is an absolutely critical point for the listener. And yes, the sources are very clear on this. Shipping is highly cyclical and extremely volatile. These stocks should be viewed as tactical allocations.
Not a core long-term holding.
Definitely not. You're making a leveraged play on current geopolitical inefficiency. You are investing in continued chaos, not in stable, predictable business growth. It's a trade, not a buy and hold investment.
Okay, so what about the indirect beneficiaries? Who profits from this environment but maybe offers a bit more stability than the wildly swinging ship owners?
For that, you should look toward the broader logistics infrastructure.
Yeah.
Think about port operations, terminals, and shipbuilding.
Shipbuilding is interesting. Why them?
Because these high rates incentivize shipping companies to order new vessels to try and regain some efficiency. But they're not just ordering any new ships. They're ordering massive, more environmentally compliant vessels.
A new generation of ships.
Exactly. Especially the ones powered by LNG. This means the shipyards that specialize in these modern carriers have stable, long-term order books. These are the kinds of infrastructure plays that can offer steadier, more predictable returns.
And finally, let's talk about the pressure points. Who are the losers who have to bear the direct cost of this shipping shock?
The losers are the companies that are reliant on either bulk imports or components that have to travel long distances, and this is the key, they lack the pricing power to pass those higher costs on to their consumers.
So who does that include?
Think about the major global automakers, chemical producers, steel manufacturers. But a really crucial one to consider is low-margin retail and apparel.
The fast fashion sector.
The fast fashion sector is a perfect example. Let's say it used to cost you $10,000 to ship a container full of T-shirts from Asia. If that freight rate doubles to $20,000, the company might have to absorb a massive percentage of that cost.
Because consumers just won't pay $30 for a T-shirt that used to cost $15. There's a ceiling on what the market will bear.
Exactly. And that is a clear, painful illustration of margin erosion. The high cost of this global inefficiency is now structurally embedded into the price of goods, and that demands caution from central banks and investors alike.
And that inefficiency ties directly into our next topic. Because while everything is getting more expensive to move around the world, our second stack of research shows that certain high-volume manufactured goods are getting incredibly cheap.
It is the great paradox. How does China manage to sell millions of cars for thousands of dollars less than their competitors, even with these rising freight costs? That's the question we need to answer next.
Right. The narrative that we constantly hear, especially in the US and Europe, is that the global auto industry is in the middle of this rapid, all-encompassing shift to electric vehicles.
All the debate is about subsidies, charging infrastructure, battery range.
Exactly. But the research we've been looking at shows that this intense focus has actually obscured a far bigger and I think a quieter story that's happening in the background. It's the story of the true volume boom.
It is, and it's the story of the internal combustion engine, the ICE vehicle. While all the media attention is focused on the technological future, China's current export dominance is actually being built on good old-fashioned gasoline cars.
So let's start with the sheer scale of this dominance. The numbers are just incredible. China has surpassed every other nation to become the world's #1 auto exporter.
That's the starting point. They've blown past the traditional giants. The estimates for 2025 put China's total vehicle exports somewhere between 6.5 and 6.8 million units.
6.5 million.
Yeah. This represents a massive multi-million unit lead over countries like Japan and Germany. It's a fundamental shift in where the world's cars are actually being manufactured.
Okay, now for the real surprise, what you call the hidden majority. Out of that gargantuan volume, that 6.5 million plus, how much of it is actually the gasoline car that the world is supposedly abandoning?
This is the stat that really stops you in your tracks. According to the recent data, somewhere between 64 and 76% of China's total auto exports since 2020 have been fossil fuel vehicles.
76%.
So if we take that projected 6.5 million exports for 2025, that means somewhere between 4 and 4.5 million of those units are still gasoline cars.
4.5 million gasoline cars. This one statistic, it just fundamentally challenges the prevailing global narrative that the EV transition is happening uniformly all across the planet.
It does. It suggests that the EV revolution is, for now, a geographically constrained story. It's primarily confined to the U.S., to Western Europe, and to the wealthier coastal cities within China itself.
Meanwhile, the vast majority of the global population is still buying the cheapest, most reliable form of transport available to them, and that is the gasoline car.
That's the reality on the ground.
So let's get to the root cause. What's driving this? The most fascinating aspect of this ICE export surge is its origin. The sources are very clear. This was not primarily some brilliant long-term export strategy.
No, it wasn't. It is instead what the research calls a necessary byproduct of domestic structural change.
Okay, what is that structural change happening inside China that has forced this massive overflow of cars onto the global market?
It's the incredible success of their own domestic transition to new energy vehicles, or NEVs. That includes pure electrics, plug-in hybrids, and fuel cells.
And that transition has been driven by huge state incentives, aggressive competition.
It's been extraordinarily successful, so much so that NEVs are now estimated to represent nearly half of all new passenger car sales in China by 2025.
Half the market. That is a hyperspeed shift. For a market to suddenly lose half of its volume for traditional cars, that must be creating an industrial catastrophe for the old guard.
It is. They're facing a crisis. The domestic market for ICE vehicles has been in steady decline since its peak back in 2017. And the legacy factories, many of which are joint ventures with global brands like GM or Volkswagen, they're now facing utilization rates that are dropping below 50% in many cases.
So China, with its historical state focus on just pure production volume, is now left with these massive, costly, half-empty factories that were designed to build cars that their own domestic consumers no longer want.
That is the core driver of this entire phenomenon.
Yeah.
China never systematically closed its old ICE factories while it was aggressively building all the new EV plants.
So they have this massive overhang of capacity.
Massive. Estimates suggest there are over 20 million units of idle ICE production capacity just sitting there across the country's legacy state-owned and joint venture firms.
20 million units. That is a huge industrial problem. For the state, closing a factory means unemployment, it means social instability, it means writing off enormous amounts of debt. So what's the survival mechanism for these state-linked firms?
The most immediate and financially rational mechanism is aggressive dumping overseas.
Just get the cars out of the country.
Get them out. Instead of taking the huge financial loss of scrapping a factory, these companies, which are being squeezed out of the hyper-competitive domestic EV market, are using that surplus capacity and their built-up inventory to flood international markets at extremely low, sometimes even loss-leading prices.
So this is, at its heart, a solvency strategy. They're exporting their industrial overcapacity to offset their domestic losses, maintain some cash flow, and just keep the factories running.
Exactly. It allows them to delay the inevitable economic and social pain of shutting down these massive production centers. They're leveraging their huge scale advantage and their state backing to just maintain output.
Which brings us to the next logical question.
Uh-huh.
Where are all these cars actually going? Because these millions of surplus cars are not competing directly here in the U.S. or in Western Europe, which have high tariffs and very strict emissions regulations. So where is the main battleground for this export boom?
They are very strategically targeting what the industry calls Tier 2 and emerging markets.
And what defines those markets?
These are regions where the affordability of the vehicle completely outweighs any regulatory concerns or the need for charging infrastructure. Price is king.
So which region specifically are we talking about?
Latin America is a massive destination, as is Eastern Europe, the vast Russia and Central Asia trade bloc, the Middle East, and increasingly sub-Saharan Africa.
And why are these markets so uniquely receptive to cheap IC vehicles right now, even as Western governments are trying to push EVs on the world?
It comes down to a combination of structural constraints of those countries. First, they often have insufficient or non-existent EV charging infrastructure.
Right.
Second, many have unstable electricity grids that simply could not support mass vehicle charging. And third, and this is the most critical point, the purchasing power and the credit systems that are necessary for a middle class to buy a high-cost EV, they just do not exist at scale yet.
So affordable gasoline cars are not a luxury or a choice. They're still the mainstream necessity for mobility.
That's it. And this is where the Chinese competitive advantage becomes overwhelming. It is purely a price game.
But it's not just price, right? The quality perception has changed.
It has. It's price coupled with a much higher perceived quality than in the past. These Chinese vehicles are often thousands, sometimes even $10,000, cheaper than comparable models from Japan, Europe, or Korea.
And they're not stripped down bare bones cars anymore.
Not at all. They often feature superior infotainment systems, modern digital tech, and a lot of comfort features. Many are built on older but globally reliable platforms that were acquired through years of knowledge sharing in those past joint ventures.
So they are offering a feature-rich, technologically modern-looking car at an unbeatable price point. And they're targeting markets where price is the single most important metric for a buyer.
It's a killer combination. Look at the specific examples from the research. The Dongfeng Rich 6 pickup truck, which is based on an older, very reliable Nissan platform, is cited as being $10,000 cheaper than its immediate competitors.
$10,000.
And that allows it to achieve this value pickup status across the rugged terrain of Africa and the Middle East. It is rapidly displacing the established Japanese and American legacy models that used to own that market.
And the pace of this market share conquest, it's just breathtaking in some of these regions. Can you give us some concrete data points on that?
Sure, look at South America. In a market like Chile, Chinese brands already command about 1/3 of the entire passenger car market as of 2024.
A third of the market.
But the most illustrative data point comes from South Africa. This has been a traditional stronghold for European OEMs for decades. In just the first half of 2025, the Chinese brand market share there jumped from 10% to 16%. During that 6-month period, Chinese firms sold roughly 30,000 ICE cars.
30,000 gasoline cars, compared to what on the EV side?
Compared to only 11 EVs sold by Chinese brands in that exact same period.
It's 11. That one data point tells the entire story. While we in the West are fixated on those 11 EVs as the future, the real structural industrial force is the 30,000 gasoline cars that are cementing China's dominance in a crucial emerging market right now.
It's a case of scale winning out over innovation, at least in the short to medium term.
So who are the companies leading this charge? It's important to clarify, as the research does, that this boom is not being led by the global EV champions we hear about, like BYD or NIO.
No, it's not. It is being led by the traditional, state-linked manufacturing behemoths. We're talking about companies like SAI, Dongfeng, BAIC, and especially Chery.
Chery is the biggest ICE exporter.
By far. Chery is the powerhouse of this movement. They exported 1.14 million vehicles in 2024. And the crucial number is that 80% of those sales were still ICE vehicles. Their strategy is pure volume, first and foremost.
And this export volume is putting immense, sustained pressure on all the traditional global automakers.
It's creating what the analysis calls a double burden for the legacy OEMs like Toyota, Volkswagen, and Hyundai Kia.
A double burden. Explain that. What are the two fronts of that war?
Okay, front number one. They must commit astronomical amounts of capital expenditure, or CapEx, to completely retool their entire global operations for the EV transition. That means building new platforms, new battery plants, new software ecosystems. It's incredibly expensive.
Okay, that's the future-facing burden. What's the second one?
The second burden is that while they are undergoing this costly transition, they are simultaneously losing market share and profitability in their historical cash cow segments.
The affordable ICE vehicles in emerging markets.
Exactly. The very segments that were supposed to fund their EV transition are now being hollowed out by this flood of cheaper Chinese competition. They have to fight a war on two fronts, and they are bleeding on both.
And as this flow of cheap cars becomes less of a trickle and more of a tsunami, we're seeing this structural competition rapidly escalate into a geopolitical and regulatory issue.
Hmm.
Importing nations are starting to push back to protect their own domestic industries.
The regulatory response is hardening very, very quickly. You have to look first at Mexico, which is highly relevant to the U.S. market because of the USMCA trade agreement.
Why? Mexico recently announced a massive tariff hike.
They did. In September of 2025, Mexico announced it was hiking tariffs up to 50% on vehicles imported from non-FTA Asian nations. And that was explicitly targeting China.
And this serves a dual purpose, right?
It does. Mexico is a huge domestic auto industry that is deeply integrated with North American manufacturing. So first, this tariff protects their local industry. But second, it directly addresses the major concern from the U.S. that Chinese manufacturers might try to use Mexico as a low-tariff backdoor to bypass U.S. tariffs and get access to the North American market.
So it's pure protectionism aimed at securing the continental supply chain. What about a country like Russia, which has become almost completely reliant on Chinese cars since the sanctions?
Russia is basically a captive market now,
Mm.
and they're in a tricky position. They have implemented higher import fees and registration taxes to try and slow the flood of cheap imports.
But they need the cars.
They desperately need the supply,
Mm.
so they have to balance this. At the same time they're raising fees, they're offering incentives to Chinese firms to build local assembly plants inside Russia. The goal is to manage the imports while securing local jobs and ensuring their long-term supply stability.
And South Africa is trying to walk that same tightrope, recruiting new clients while also discussing protective measures.
That's the perfect description. A tightrope walk. South Africa is actively recruiting Chinese firms to come and build new assembly plants, which brings in jobs and investment. But at the same time, there's a very public discussion about the need for potential tariffs or quotas against the low-cost imports.
To stop their existing domestic auto sector from being completely wiped out.
Exactly. To protect the thousands of jobs that already exist. It's a very difficult balancing act.
So all of this means that for investors looking at these Chinese automakers, a company like Chery or SAIC, they might see this massive short-term volume growth, but that growth is laced with a huge amount of political risk.
Absolutely. The simple analysis that, export growth equals a growth stock is just completely insufficient here. Investors have to incorporate these increasing political and regulatory risks into their valuation models.
Risks like anti-dumping investigations, high tariffs.
Anti-dumping, tariffs, and forced localization demands. All of these things cut directly into profitability.
And what does that do to a company's ROIC, their return on invested capital?
It means that the long-term return on invested capital is likely to be severely diluted. To get around tariffs like Mexico's 50% hike or potential future EU action, these Chinese firms have to invest billions of dollars in building local production and distribution networks all over the world.
Which is a massive capex commitment.
A huge one. And it drastically dilutes the short-term profits they're making from just shipping cheap inventory out of their existing factories. The long-term cost of achieving global dominance is building local manufacturing. It's expensive.
And this brings us right back to where we started, connecting our two big topics. If millions of affordable new gasoline cars are entering the developing world every single year, what is the fundamental impact of that on global energy demand?
Well, it creates a strong structural support for gasoline and diesel demand in the developing world. And this is a factor that is often dramatically understated in Western market forecasts.
So this directly challenges that widely accepted narrative we hear from agencies like the IEA about reaching peak global oil demand very soon.
It does, and profoundly so. Many of those projections from the International Energy Agency rely on the assumption of rapid EV uptake happening globally everywhere.
But the data is showing us we have what you called a dual structure in the global market.
We do. On one side, you have the developed nations like the U.S. and Europe who are aggressively trying to reduce their oil consumption by shifting to EVs. Yes, that is happening, but that reduction is being structurally and significantly offset by emerging markets, which are aggressively adopting these affordable Chinese ICE vehicles. That structurally boosts long-term gasoline demand in a huge portion of the world.
So if the IEA is forecasting peak oil demand sometime around 2030, how much does this massive multi-million unit flow of ICE exports delay that moment?
Analysts are debating this intensely, of course, but the volume is so large, we're talking 4 to 4.5 million new ICE units annually, that some believe it could push the true global peak oil timeline back by 5, maybe even 7 years.
It's in a massive counterweight.
It's a huge counterweight. Regions like Africa and Latin America are now forecast to see sustained growth in their liquid fuels demand, precisely because of this affordability factor.
So the key takeaway for energy investors is this. You cannot assume a rapid collapse of oil prices or refining margins just because EV adoption is accelerating in California or in Norway.
That is the essential insight from all this data. You have to scenario plan for how long this developed EV plus emerging ICE dual structure is going to persist.
And as long as China is prioritizing its own industrial solvency by flooding the developing world with these cheap ICE cars.
The demand for liquid fuels will remain structurally supported in the global south. And that demand ensures that the expensive, inefficient movement of crude oil, which was our first story, remains profitable for shippers. The two topics reinforce each other perfectly.
Geopolitical inefficiency keeps shipping rates high.
And industrial overcapacity in China keeps global oil demand supported.
It's a powerful reminder that the global economy is segmenting, and China is exploiting that segmentation perfectly, forcing legacy players to fight on two fronts, all while the cost of moving everything stays ridiculously structurally high. So this deep dive has really shown us that the forces defining the global economy in late 2025 are, they're structural, they're not cyclical. Let's just quickly summarize the critical insights we've uncovered today.
Okay, we started by establishing how these geopolitical flashpoints, the conflict in the Red Sea, the intensified Russian sanctions, and that all-important ton-mile effect, are creating an expensive structural inflation in logistics.
Right. And this inefficiency acts as a persistent headwind for the general economy. It's keeping the floor on inflation high, and it's forcing central banks to remain cautious, delaying any kind of widespread return to an era of cheap money.
Exactly. And then we pivoted to see how China's own domestic success in moving to EVs has created this massive industrial overflow of cheap gasoline cars.
And that overcapacity is now being used to rapidly conquer emerging auto markets. It's fundamentally challenging the cash flows, the market share, and the long-term profitability of every legacy automaker from Japan, Korea, Europe, and the US.
And the core truth that connects these two seemingly different stories is that the global economic environment today is defined by the strange pairing of inefficiency, which demands high prices on the seas, and overcapacity, which drives incredibly low prices for goods on the ground.
And these dynamics ensure that global competition is being decided by pure scale and by pricing power, often in these politically sensitive, high-volume, but low-margin markets.
That creates a very complex risk profile for investors. Supply chain stability, we can now say, is officially a luxury of the past.
Which means the focus really has to shift. It has to shift away from just where innovation is happening in the West and toward where the sheer volume is being traded in the global South.
And so we'll leave you, our listener, with this one provocative thought to consider. The true battle for global market share and for economic stability is often unfolding quietly, far away from the headlines you read every day in the US and Europe.
It's happening on those container ships that are rounding the Cape of Good Hope, adding 3 weeks to delivery times.
And it's happening in the car lots of South America and Africa, where a $10,000 price difference is what determines who wins or loses an entire market. These quiet structural shifts are what fundamentally alter global inflation and investment risk in ways we have to constantly monitor.
Understanding the economics of these underserved layers of the global market is now absolutely critical to understanding global energy demand and the future profitability of so many legacy industries. Don't forget to subscribe and hit that like button.